Thanks a lot for the invitation to join you all here today at the 2012 Business Law Institute. So I often tell people when I give a talk that I look forward to taking their questions at the end of my speech. And as a policy maker, I think it's a great way for me to find out what people have on their minds. But today I have to admit I'm not so sure. We've got a room full of lawyers here. They're all trained in cross-examination, and it's a little more intimidating to invite questions from such a group. But lawyer jokes aside, and there's something more pathetic than having an economist tell lawyer jokes, I have to say. But I do look forward to your questions, both on what I have to say today and whatever else is on your mind regarding the Federal Reserve. So as Dennis mentioned, I became president of the Federal Reserve Bank of Minneapolis in October of 2009. And one of my main objectives since then has been to make both the Minneapolis Fed and the Federal Reserve System more open and more transparent. And I've been delighted to learn that I'm not alone in this pursuit. And I see many positive developments along this line in terms of openness and transparency throughout the system. So I'm going to spend the first part of my remarks providing some background about the functioning of the Federal Open Market Committee. As Dennis mentioned, it's the monetary policy making arm of the Federal Reserve. And then I'm going to, the meat of my remarks will be focusing on three recent and significant improvements in the FOMC's communication about monetary policy. I'll wrap up with a brief discussion of why these improvements have occurred recently, and then open the floor for your questions. But I think it'll be helpful if I start by giving you a preview of where I'm going. So let me give you a preview of these recent changes in communication with the notice I'm going to spend a lot of time going into them in great detail. So the first change is that after 4 of the regularly 8 scheduled meetings that it holds each year, the FOMC now releases the meeting participants' assessments of the evolution of future policy. The second is that after those same 4 meetings, the chairman of the FOMC, Ben Bernanke, now gives a press conference. And the third improvement in FOMC communication is that in January of 2012, the committee released a consensus statement describing its long-run framework. Now, the first 2 changes that I described, the release of assessments of the evolution of future policy and the press conferences, have received considerable attention from the media and the public. But today I'm going to spend most of my time actually discussing the third item, the framework statement. The press reports of the FOMC often highlight apparent differences of opinion among meeting participants, a difference of opinion on policy. In contrast, the framework statement that we released in January is important because it details the common principles regarding goals and strategies that actually shape FOMC decision making. Before proceeding further, I'll remind you that my remarks today reflect my thoughts and not necessarily those of others in the Federal Reserve System. So let me begin with, to help you understand though the significance of these changes that I'm going to spend most of my time on, I'm going to start by providing some basic background on the structure and operation of the Federal Reserve System. So I like to tell people that the Fed is a uniquely American institution. And what do I mean by that when I say that? Well, when you look at central banks around the world, the U.S. central bank, relative to its counterparts, is highly decentralized. And the Federal Reserve Bank of Minneapolis is one of 12 regional reserve banks that, along with the Board of Governors in Washington, D.C., make up the Federal Reserve System. So our headquarters, I'm sure everyone knows this, but I'll just say it, just where the head of an Avon Bridge crosses the river, that big building, and on your left as you're going across the river, that's where the headquarters of the Minneapolis Fed. And our bank represents that headquarters building is actually the headquarters of the 9th of the 12 Federal Reserve Districts. And that includes Montana, the Dakotas, Minnesota, northwestern Wisconsin, and the Upper Peninsula of Michigan. So this is by the second biggest district by area of the 12. Just to give you a feel for that, we have a branch located in Helena, Montana, And it takes me as long to fly to Helena as it does to fly to Washington, D.C. for the meetings. It just gives you a feel for how big our district is. So 8 times per year, the Federal Open Market Committee, the FOMC, meets to set the course of monetary policy. Now, I talked earlier about FOMC participants, and here's what I mean by that. All 12 presidents of the various regional Federal Reserve banks, including myself, and the 7 governors of the Federal Reserve Board contribute to these deliberations in the meetings. So right now, I just said there were 7 governors. Actually, right now there are only 5 governors because 2 of the positions are unfilled. But the committee itself, so these are the people who participate in the meeting, but the committee itself consists only of the governors, the president of the Federal Reserve Bank of New York, and a rotating group of 4 other presidents who currently are Cleveland, Richmond, Atlanta, and San Francisco. Now, I was on the committee in 2011, and I'll be on it again in 2014. Minneapolis serves on the committee every 3 years. Now, in this way, and this is what I meant by talking about a uniquely American structure, the structure of the FOMC mirrors the federalist structure of our government, because representatives from the different regions of the country, the various presidents, have input into FOMC deliberations. So I consider this federalist structure important because it fosters valuable two-way communication between Americans and their central bank. It's exactly the kind of two-way communication we're going to be engaged in today. One direction of communication is what's happening right now. It's from the regional Fed presidents to the residents of their districts. But the other direction, questions and comments from that we get from the input that we provide to the FOMC relies critically on that other direction. The information we receive from our districts about what's going on locally in terms of the economy. So that's going to be, so that's sort of the basic background of how the Federal Reserve System operates and the role of the Minneapolis Fed in terms of how the FOMC functions. So with that background, I now want to turn to the recent changes in FOMC communications. And to appreciate those, we have to have some historical context. So over the past 30 years, central banks all over the world have become much more transparent about their objectives and how their current actions allow them to achieve those objectives. And this transparency is widely viewed by both policymakers and scholars as an important means of enhancing the effectiveness of monetary policy. So most central banks aim to keep medium-term inflation low and stable. And by low and stable, they're generally agreement around 2% annually. And they have been quite successful at achieving that goal over the past 20 or 25 years. And they view that success as being due in part to their communicating on an ongoing basis how their current policy actions are consistent with that goal. So what are the benefits of transparency? And I see at least 2. Now, I think the first is broadly appreciated. By being clear about their objectives, central banks are better able to achieve those objectives. So for example, if the central bank has announced a target for inflation of 2% per year, firms' employees know that wages need to grow by 2% to keep up with the cost of living. That knowledge helps prevent wages from growing so fast that firms actually have to raise prices by more than 2% to cover their labor costs. That, in turn, contributes to keeping inflation under control. In brief, transparency about what we want inflation to be helps anchor inflation expectations. Now, the second benefit of transparency is less appreciated, but I feel it's no less important. A transparent central bank is more accountable. It's more accountable to the public because it's forced to be more disciplined in ensuring that its policy actions are, in fact, consistent with its policy objectives. The central bank knows that the public will be able to track its performance. And when performance matches words, the public will have an even stronger belief in the central bank, and that'll serve to anchor inflation expectations even more solidly. So So there's been a trend, this was internationally I've been talking, there's been a trend towards central bank transparency internationally. What's been happening here in the United States? So I think we can all take pride in the fact that under Chairman Bernanke and his predecessor, Chairman Greenspan, the Fed has made enormous strides in transparency. It's easy to forget that as recently as 1993, just under 20 years ago, the FOMC would act and not tell anyone what it had done for 90 days. And it was not until 2000 that the FOMC began issuing the statement that many of us now take for granted. And it was a decade ago that the roll call vote of FOMC members was added to the statement. So over the past 15 years or so, there's been substantial progress in the United States in terms of monetary policy transparency. So that was the progress, I would say, up until the beginning of 2011. So let me tell you what the state of the world was, essentially, in terms of communication from the FOMC at the beginning of 2011. The committee had arrived at three main forms of communication at that point. First, immediately after every meeting, the committee issues a carefully worded but brief statement intended to describe the current state of the economy and to describe the current stance of monetary policy. Second, 3 weeks after each meeting, the committee issues a carefully worded set of minutes that provide a longer but still relatively high level description of interactions within the meeting. And then third, after the January, April, June, and October, November meetings, the FOMC releases a summary of economic projections. Among other things, these quarterly releases contain information about meeting participants' goals for medium run inflation and unemployment. And by medium run, I mean roughly over the next 5 to 6 years. Now, one thing to highlight, and this will come up again as I talk about the communication changes that have taken place, these summary of economic projections are essentially based on a survey of all meeting participants. And then that information is released, aggregated information about that survey is released to the public. Okay, so that's the backdrop. That's where we stood as of the beginning of 2011, really as of April 2011. So let me turn then to the communication changes that have taken place in the last year, since April 2011. I'll start with the release of information about FOMC meeting participants' assessments of future policy. Now, to appreciate this change, it's important to recall that the current stimulative effect of monetary policy is not just based on what's happening today. It's not just based on what the one-day interest rate is, for example, at this moment in time. It relies critically on people's expectations of future monetary policy actions. Monetary policy operates by affecting interest rates. If people expect short-term interest rates to stay low for a long period of time, longer-term interest rates, like those on 3-year car loans, will also tend to be low, other things equal. People will borrow more to finance their consumption needs, and firms will borrow more to undertake investment that stimulates both consumption and investment, and thereby stimulates the economy and employment in particular. But the point of this then is the impact of current policy depends not just on how low interest rates currently are, but on how long interest rates are expected to remain low. So to help shape those expectations, the committee decided in January of 2012 to release on a quarterly basis a summary of meeting participants' evaluations of the appropriate evolution of future policy. In particular, the release includes the participants' current assessments about the appropriate setting for the year-end Fed funds rate in 2012, 2013, and 2014, as well as their judgments about the appropriate year of the first increase in the Fed funds rate. Now, just to be, I should be clear that what I have in my script about this, that these assessments are released anonymously. So what you'll see, the way it's summarized is you'll see a collection of 17, there's a graph that depicts in 2012, at the end of 2012, where the 17 participants expect the Fed funds rate to be. So at the end of 2012, you would see 14 dots at 0 to 25, basically at 0, and then 3 that are above that. As we move forward, more of them above 0 and fewer are clustered at 0. And for those who believe that the appropriate year the Fed first increase in the Fed funds rate is after 2014, you'll see that summary again of the numbers of participants who believe that. Now, one thing that's important to stress here, and as I've just described what's in that chart, these assessments are not forecasts of what policy will be. And they're not positive, to use the economist's language. They're normative. They're judgments about what appropriate policy should be. Different meeting participants might well have different views about the evolution of economic conditions and about how monetary policy should respond to those conditions. And those differences in viewpoints will be incorporated into different assessments of when interest rates should be raised or lowered. So, for example, as I just described to you, the recent release of these policy assessments in April showed that some of the participants anticipated that it would be appropriate to raise rates by the end of this year, 2012. Others anticipated that it would be appropriate to wait until 2015 to do so. Now, these policy assessments represent individual views. Essentially a survey of the meeting participants about what they see the track of appropriate monetary policy to be. Because these policy assessments represent individual views, it creates a possibility of a conflict between the information in the policy assessments and the committee's policy statement issued at the end of each meeting, which right now, for example, says that the committee anticipates that conditions will warrant interest rates being extraordinarily low, at least through late 2014. I think when we think about these potential conflicts, as Chairman Bernanke has pointed out, the policy assessments are but one of many inputs into the policy process. And in his words, and echoing them and agreeing with them, what's in this statement that's released at the end of every meeting, the FOMC statement, trumps whatever information is in the policy assessments themselves, because they're just an input into the process. So these releases about FOMC meeting participants' policy assessments will be part of the committee's quarterly releases of its economic projections that take place after the January, April, June, and October, November meetings. I say October, November because sometimes that second to last meeting is sometimes in October and sometimes in November. Okay, so that's the first of the innovations that I described, this release of assessments of the course of policy over the future. Let me turn to the second of the three recent communication innovations. So beginning last April, the FOMC made a major step, I think, towards transparency by deciding to have the chairman hold a press conference after each of these quarterly meetings that I just described earlier, the January, April, June, and October, November ones. I think these press conferences allow the chairman to explain the committee's actions in ways that a short written document cannot. He has more time, more words at his disposal. He can respond directly to questions or concerns about the committee's actions. I think overall, the press conferences allow the committee to be more effective by explaining its actions more clearly and also allow it to be more accountable to the public for those actions. So this started last April of 2011, so that means there have now been 5 press conferences, and I think it's just been remarkably successful. In no small part, I see that success as being directly attributable to Chairman Bernanke's particular gift for exposition. So that's the first 2 changes I wanted to talk about, the release of participants' assessments and then the press conferences. Now I want to talk about the third, what I view as the most important change in communication that's taken place in the past year or so. And that is the FOMC's release in January 2012 of a 5-paragraph statement describing its long-run framework. The statement does not represent any change in the committee's approach to policy. But it does represent a major step forward in the committee's communication of that approach to the public. In particular, I think of this statement as providing the basic principles of how the committee implements its statutory dual mandate that monetary policy should promote price stability and maximum employment. So I won't go through the statement in any detail. Frankly, there's no need for me to do so. I think it's short and remarkably well worded. It deliberately shies away from technical language. There was a special concern to all of us was that it should be readable by a wide cross-section of Americans. And I encourage all of you, and I encourage all Americans, in fact, to read it when you have the opportunity, because it really does represent, I think, an important vehicle to understand the principles which underlie the making monetary policy in the United States. But so instead of going through it in detail, what I'm going to do instead is describe 4 aspects of the framework statement that I view as especially important. So the first of these 4 aspects is that it provides a quantitative translation of the words of the term price stability. So I mentioned, probably very quickly, that the committee has a statutory dual mandate from Congress, and that is to promote price in making monetary policy. And that's to promote price stability and to promote maximum employment. So the framework translates those words, price stability, into a quantitative measure, which is a 2% target for inflation. The American public need guess no longer about the Federal Reserve's inflation intentions, either on the upside, and that's often where you get a lot of concerns, but importantly too, on the downside. 2% is our goal. So the second aspect of the framework is that it describes how the committee weighs the 2 mandates I just mentioned, promoting maximum employment and promoting price stability against one another. So importantly, and I think this is a point that often gets missed in the discussions about monetary policy, and I think it's great that the framework statement has this in there. It stresses that the 2 mandates are typically complementary to one another, in the sense that keeping unemployment from rising too high also serves to keep inflation from falling too low. And that's why it's important to think about that inflation target as being, you're trying to keep inflation from falling too low and also keeping it from rising too high. So I think this point about the complementarity of our two mandates is often underemphasized in popular discussions of monetary policy. So the third point is the framework enjoyed broad consensus support among meeting participants. This suggests that any change in the framework, and the committee does allow the possibility of changes being made in the framework, but it does suggest that any changes in the framework will require the same level of broad consensus support. And I hesitate to use this term, but in this room, but in this sense, one can think of the framework as being like a constitution. That's I'm sure red meat for a lot of people here, but the basic point is there was broad consensus support to implement it. We expect there to be require broad consensus support to implement changes. And the fourth key feature is that while the statement provides a numerical target for inflation, as I just described, 2% per year, over the medium run, it does not provide a similar explicit quantitative interpretation of the second mandate, maximum employment. And the statement itself says, I think this very well, the maximum level of employment is largely determined by non-monetary factors that affect the structure and dynamics of the job market. Now, what are these non-monetary factors? There's many of them, and there's heterogeneity among economists about which ones they think are the most important. But certainly think about population trends, demographics is mattering. The incentives that are built into our tax system matter. The incentives that are built into social insurance safety nets matter. The returns to human capital accumulation that are available to young people. And simply, social norms matter. So all of these factors that are well outside the purview of monetary policy have an impact on what we would view as the maximum level of employment. All of these non-monetary factors are hard to assess on a real-time basis, and they are changing over time. And what makes monetary policy hard, in large part, is, as the framework statement goes on to say, and I quote here, the committee's policy decisions must be informed by assessments of the maximum level of employment, recognizing that such assessments are necessarily uncertain and subject to revision. These assessments will inevitably lead to differences in thinking about policy. In particular, if one monetary policymaker sees the level of maximum employment as being higher than another, then that first policymaker will typically favor more accommodative monetary policy than the latter. So let me wrap up. We'll have plenty of time for questions. We've seen 3 major changes in FOMC communication in less than 1 year's time. And I think a very natural question to ask is, why have there been so many changes in such a short period of time? And I think there are 2 reasons for this. The first is that as an intellectual and as a policymaker, Chairman Bernanke has long been dedicated to the proposition that transparency and clarity are essential to the making of good monetary policy. And I think his central vision along these lines has been a critical force behind these recent steps. So that's, I think, on the one reason. But the other reason, frankly, has to do with the current state of policy. So right now, the FOMC is targeting a Fed funds rate of between 0 and 25 basis points. That is between 0 and 0.25 percentage points. The rate can't get any lower than this. But one way to vary monetary stimulus today is to influence the public's expectations of how long the Fed funds rate will stay as low as it is, and also to try to provide some information about how fast the Fed funds rate will rise when it does start to rise. So I think communication, while always important, is especially so today. Now, I think we should all take pride as Americans in the recent improvements in FOMC communications. There is still more to be done. I think that's always true. In prior speeches, I've spoken about the need for what I would call a public contingency plan on the part of the FOMC. Now, I think such a plan would provide clarity in a couple of different ways. First, it would allow the public to know the kind of scenarios, both surprisingly positive, surprisingly negative, that are under consideration by the committee. And second, it would inform the public about how the committee plans to react to those scenarios. So thanks a lot for listening to my remarks. I'll certainly be happy to take your questions now on any other topic you might agree. Thanks a lot.